First, we got to talk about how does a TIPS function? What does it do for you?
Sure. Well, its name attempts to capture the theme here, which is inflation protection. In essence, it's an instrument issued by the Treasury, and it can come in short, intermediate, and long maturities. It has two components to it. When you're buying a TIP, you're attempting to protect yourself against inflation,
right.
And there is a component there where your coupon will reset based upon what CPI does.
Okay.
And so you will float, as it were, with whatever inflation is doing as measured by CPI.
This isn't like a floating rate mortgage where it resets to prevailing interest rates. The coupon changes based on a different calculation of what the principal is worth, right?
That's correct. So
okay.
It looks over to CPI and makes that a direct calculation and adjusts your coupon based on what that CPI number looks like as we move through time.
Okay.
However, there's a second component to the TIPS that people don't tend to focus on, and this is really where we want to dig in a little bit, and that is what is called the real yield component.
Mm-hmm.
Now what that is when you buy a TIP, of course, as we just mentioned, you're going to get that coupon adjustment. Whatever inflation does, you'll get that adjustment and coupon paid. But when you buy the security, you're locking in essence, a fixed rate at the date of purchase.
Right.
So let me give you an example. For instance, a 10-year TIP. If one were to purchase a 10-year TIP today, you would be locking in a real yield of a little less than 1.5% for 10 years. So the instrument works this way. You own 1.5% real yield.
Right.
And then as inflation goes up or down, our view is that will go up. You'll get that coupon. But at the end of the day, what you'll wind up with is a 1.5% real yield return.
Okay, 1.5% on top of inflation.
On top of inflation.
So if you give them $1 million, you'll have $1 million worth of purchasing power at the end, plus that 1.5%.
That's exactly right, Dan.
Sounds like a good deal if you're worried about your $1 million not buying you as much 10 years from now as it does now. What's wrong with buying them right now?
There has been so much demand in TIPS that it's pushed that real yield component down to historically low levels. So let me give you the most extreme example. If one was concerned about trying to protect against inflation for, let's say, 5 years,
mm-hmm.
There is a 5-year TIP option, and that 5-year TIP, in essence, has a negative real yield.
So you're paying an insurance premium to Uncle Sam to hand you back your money in 5 years.
That's exactly
your
right.
Purchasing power.
Yes, I would say you're overpaying Uncle Sam.
Okay.
To try to protect against, preserve your principal, because after all, in this example, you're actually not preserving all of your principal. You're guaranteeing yourself you're going to lose a little bit of it because you have a negative real yield. You're paying Uncle Sam, and then you'll get inflation. So you're going to slip a little bit on the purchasing power because you're overpaying for the real yield component.
You had an interesting article, Cliff, that you pulled together on the history of this whole concept of inflation protection. Can you start with the history you dug up going back several centuries?
People have been trying to protect themselves from inflation for hundreds of years, actually. Indeed, in 1780, the state of Massachusetts issued a inflation-protected bond. And what they were protecting against was the price of wool, corn, beef, and shoe leather.
Okay.
So what we're talking about here is not new. However, the most deep instrument that folks talk about when they're trying to protect against inflation is the TIP, or Treasury Inflation Protected Security.
Another interesting thing in your paper is that you looked at the correlation of TIPS. Now theoretically they should be a 1-to-1 correlation. It's inflation protected, but you actually found it wasn't, and other instruments have a better correlation. Is that correct?
That is correct. We've done a lot of work on this, and what you'll discover, which surprises most people, is that despite its name, inflation protection,
right.
Despite that name, the correlation over long periods of time between TIPS and CPI is virtually zero.
Wow. Can you explain that a little further? How is that possible?
Sure. So let me just give you a statistic here to makes us have a little bit of pause. Real yields move up and down despite what inflation might actually be doing, depending on supply and demand and the like. And that's what causes this, at the end of the day, zero correlation. But what we're really concerned about is if real yields begin to gravitate back to the historical means that we've seen throughout time, you'd get a near doubling of real yields, for instance, mm-hmm. in the 10-year Treasury, inflation-protected security. So what would that mean to you as an investor? Well, if you purchase that security today at a 1.5% real yield, inflation is moving along, you're going to get that coupon. But somewhere along the way, that real yield gravitates back to its historic mean of 3%.
Right.
You would have a real price drop in that bond that you hold, somewhere on the order of north of 10%.
Wow. Okay, so that's a capital hit, a mark-to-market loss. Can you buy it? Assuming we don't have enough money to make your minimum, is there an actively managed TIPS fund that sort of manages the maturities? Can you, lessen your potential losses that way?
There are TIP funds that do manage across the maturities. They're out there, quite a few of them actually. I think the real challenge here is most managers are still trying to get some level of real yield within the portfolio, which is in essence gravitated the maturities further out the maturity spectrum of TIPS.
Right.
And so in that quest and thirst, perpetuated by the Fed, thank you, at zero rates, in that quest for getting some sort of yield, most of the TIPS funds have kind of gravitated out to the longer maturities. So you're still very exposed to that
10% loss.
Yeah, to that price volatility.
So you had some interesting alternatives that you said actually had a better correlation to inflation, which I think some people might find surprising. What did you find that you should be buying if you're really concerned about inflation?
There are several opportunities out there with very high correlations. Among the strongest are floating rate bond instruments. Mm-hmm. Examples would be corporate bonds that float with LIBOR.
Okay.
And LIBOR is a measure of reset of interest rates. Can be monthly or quarterly, typically quarterly.
It's the rate international corporations pay on short-term debt, right?
That is,
or it's set to that, yes.
That's exactly right.
Okay.
And so it's very sensitive to what rates are doing, and because day-to-day rates are very sensitive to inflation views and actual inflation, they reset just like a CPI might reset.
Right.
However, what we found is that the correlation of LIBOR to CPI was much greater than that of TIPS. In fact, as high as 80% correlation.
Wow.
So,
okay.
Yeah, it's a very powerful correlation, and so we think that's a better way in this environment to protect against the possibility for rising rates.
But still, you're stuck with these low rates, aren't you? I mean, if you're going to protect yourself with having a short maturity of corporate debt, what kind of rate can you get out of a portfolio right now?
Well, here's the great thing about the bond market. There are so many different types of instruments that exist within the market that provide varying degrees of yield for risk that we believe is a great way in a reasonably conservative portfolio to add yield, have the portfolio float with LIBOR, in essence getting that higher correlation, and not sacrifice too much yield or get yield on with a lot of price risk.
And just one last question. What kind of maturities are we talking about for a really inflation-averse investor?
Sure. We would typically go with a diverse portfolio that is somewhat laddered,
okay,
from shorter maturities to longer, perhaps as long as 10 years. And of course, it depends on the individual client. But we think the inflation story will likely play out over the next 10 years. And so we would diversify it, but concentrate it somewhere in the 2 to 5 year area. And we would have a diversity of instruments within that, some we mentioned, and probably a little bit of high quality, high yield as well.
Okay.
And the idea there is spreads or yields on high yield are actually quite reasonable, particularly for the highest level of high yield, double B, almost 6%, 5-6% yield. We would keep that maturity very much on the shorter side, because it's typically a fixed rate instrument, and just allow that yield to embed itself within the portfolio and then ultimately roll off through the maturity. So a very diverse portfolio, but very defensive against the possibility for inflation and higher rates.